Every market crash creates two groups of people. One panics and sells, the other quietly gets richer. And most people don't realize which group they're in until it's too late. In this video, I'm going to unpack the fear everyone feels when markets shake, why waiting on the sidelines for the perfect crash usually backfires, and how to use ETFs in a simple way that doesn't require jargon or constant decisions. We'll look at two ETF classes that actually held up in past crashes and the two ugly economic scenarios most investors aren't prepared for. Then we'll break down a defensive income ETF designed to keep working when patience gets tested, and we'll put all three pieces together into a single portfolio. And in the end, I'll show you how this exact setup could realistically turn a $10 daily investment into a $600,000 plus portfolio that pays over $22,000 in annual dividend income without perfect timing, stock picking, or guessing the next crash. Most investors won't say it out loud, but a lot of people feel uneasy right now. Prices feel high, headlines swing between optimism and panic. And there's a silent question that keeps resurfacing. What if the market crashes right after I invest? That fear is normal. It shows up whenever markets feel expensive, whenever growth slows, and whenever words like recession or bubble start circulating. And when that fear shows up, most people respond the same way. They stop, they wait, they tell themselves they'll invest once things feel safer. The problem is that markets almost never feel safe at the exact moment the biggest opportunities are created. The moments that feel most uncomfortable in real time are often the ones that look obvious in hindsight. There are two uncomfortable truths investors have to accept. First, recessions aren't rare events. They're part of the system. Over the last century, the economy has gone through downturn after downturn. Different causes, same pattern. Growth slows, confidence breaks, markets fall, and eventually recover. Nobody knows when the next one is coming, but history is clear that another one is always on the way. Second, more wealth is created during crashes and recessions than during calm bull markets. Not because downturns are easy, but because prices fall while emotions spike. That combination creates an opportunity for people who are prepared and permanent damage for people who panic. This is where most mistakes happen. When markets rise, confidence increases. When markets fall, fear takes over. Instead of asking, "Where is money moving?" people ask, "How do I make this feeling stop?" That emotional reaction is what turns temporary declines into permanent losses. I want to be very clear about something before we go any further. This video is not about predicting the next crash. Anyone who claims they know exactly when a recession will happen is just guessing. Markets don't send calendar invites. They don't warn you. Trying to time the exact top or bottom usually leads to hesitation, missed opportunities, and ultimately regret. What actually matters is positioning. Where your money is when things get uncomfortable. Because when fear hits, money doesn't disappear, it moves. So the real question isn't if there will be another crash, it's what tends to hold up when confidence breaks, and how to prepare for that without betting everything on one idea. To answer that, we first need to talk about why the most common plan investors rely on, waiting for the crash, usually fails. After hearing all of that, a lot of people still land on the same plan. They tell themselves, "Okay, I get it, crashes happen, opportunities show up, I'll just wait for the next crash and then I'll invest." On the surface, that sounds smart, patient, disciplined, almost responsible. In reality, it's one of the most common ways people sabotage themselves. The problem isn't the logic, the problem is how humans actually behave when fear shows up for real. Because the version of you calmly waiting for a crash is not the same version of you watching your account balance drop every day while headlines scream about recession, layoffs, and uncertainty. Crashes don't feel like sales, they feel like something is broken. When markets fall fast, your brain doesn't say, "Great, things are cheaper." It says, "What if this keeps going? What if this time is different? What if I'm catching a falling knife?" And that hesitation is exactly what causes people to miss the very opportunities they claim they're waiting for. This is why historically most investors don't buy near market bottoms. They buy after things feel safe again. And by the time things feel safe again, prices are usually much higher. Another issue with waiting is that crashes don't announce themselves cleanly. Markets don't drop in a straight line, hit a clear bottom, and then politely turn around. They swing. They fake you out. They bounce, fall again, and create constant uncertainty. Waiting for the all-clear signal usually means waiting too long. But there's a deeper misunderstanding underneath all of this. During crashes, money doesn't disappear, it moves. When stocks fall, capital doesn't evaporate into thin air. It flows away from certain assets and toward others. Investors don't stop making decisions, they change priorities. Risk becomes less attractive. Stability becomes more valuable. Liquidity starts to matter more than growth stories. If you only focus on the falling asset, like stocks, it feels like chaos. But if you zoom out and look at the full system, you start to see patterns. Fear pushes money into places that feel safer, more reliable, or more necessary. This is why simply waiting in cash can work against you. While you're waiting for the perfect moment, the capital is already rotating. Some assets are already benefiting from that fear-driven movement. Others are getting repriced lower in ways that create long-term opportunity. And there's another issue people rarely talk about. Waiting requires confidence. You need confidence not just to wait, but to act decisively when the moment comes. Most people overestimate how confident they'll feel in the middle of a downturn. Fear doesn't sharpen decision-making, it clouds it. That's why preparation beats reaction. If you already understand where money tends to move during stress, you don't need perfect timing. You're not trying to guess the exact day the market bottoms. You're positioning yourself so that no matter how the headlines look, your portfolio isn't fighting you emotionally. Now, in a couple of minutes, I'll show you the assets that have historically performed best during market crashes. Then I'll walk you through my own cash-ready portfolio, and in the end, I'll show you how this exact setup could realistically turn a $10 daily investment into a $600,000 plus portfolio that pays over $22,000 in annual dividend income, without perfect timing, stock picking, or guessing the next crash. This is exactly why crashes tend to reward people who are already invested and disciplined, not people trying to jump in at the perfect moment. The result doesn't come from one brave decision, it comes from staying invested while others hesitate. Consistency beats courage. Systems beat gut feelings. But before we get there, we need to address the question that actually controls everything. Instead of asking, when will the crash happen? A much better question is, what assets have historically held up or even benefited when fear took over? And just as important, how can I use those assets in a simple way that doesn't require me to predict the future? To answer that, we need two things. We need a tool that's flexible and simple enough to use in uncertain markets, and we need to understand what history actually shows us about how different assets behaved when things went wrong. That's where ETFs come in. And before we look at which ones matter most, we need to make sure we're on the same page about what an ETF actually is and why it's such a powerful tool during volatile periods. An ETF is one of those things that sounds complicated until you realize it's actually very simple. Instead of buying one single company and hoping you pick the right one, an ETF lets you buy a basket of many companies or assets all at once. One purchase, instant diversification. Think of it like this. If you buy one stock, you're making a very specific bet. You're betting that this one company executes well, manages risk properly, and survives whatever the economy throws at it. That can work when markets are calm, but when markets are volatile, that concentration becomes a liability. An ETF spreads out that risk. If one company struggles, it doesn't sink the entire investment. If one company thrives, it contributes without carrying the whole load. You're no longer relying on a single story, you're relying on a broader theme or behavior. Here's what that means in real terms. Say you invest $1,000 into a single stock. You're making a very specific bet. That one company needs to execute well, manage debt, survive competition, and hold up if the economy weakens. If that stock drops 50%, your $1,000 becomes $500. If the company fails, that money can go to zero. Now take that same $1,000 and put it into an ETF that holds 100 companies. Each company represents roughly 1% of your investment. If one of those companies completely collapses, your portfolio doesn't blow up. You lose about $10, not $1,000. If one company does extremely well, it contributes to the overall return without carrying all the risk. This matters a lot during crashes. When markets fall, emotions run high, prices move fast, news changes daily. The last thing most people want to do in that environment is constantly research individual companies, read earnings reports, or decide whether one specific stock is about to fail. That pressure leads to hesitation and often bad decisions. ETFs reduce that pressure. They allow you to stay invested without needing to micromanage every move. You're not asking, is this one company going bankrupt? You're asking, is this type of asset still serving its role? That's a much calmer, more productive question. This matters during crashes because prices don't move slowly. They drop fast. In 2008, the overall stock market fell around 35%, but many individual stocks fell far more than that. Some banks dropped 70, 80% or went to zero. Investors holding individual stocks had to make life or death decisions about specific companies while fear was at its peak. Another reason ETFs work well during uncertain times is flexibility. You can buy and sell them just like a stock. You don't need special accounts. You don't need to lock your money up. You don't need to predict exact outcomes. You're simply choosing exposure. It's also important to be honest about what ETFs don't do. They don't remove risk completely. They don't guarantee profits, and they won't protect you from short-term volatility. What they do is reduce single-point failure and help you stay invested when emotions try to pull you out. That's a huge advantage, because most long-term investing mistakes aren't caused by choosing the wrong asset. They're caused by abandoning a reasonable plan at the worst possible moment. ETFs make it easier to stick with a plan because they're designed to absorb shocks rather than amplify them. This is especially true when you're thinking about crashes. During downturns, you don't need to be perfectly right. You need to be positioned in a way that doesn't force you to panic. You want investments that reflect how people behave under stress, not how people behave when everything's going smoothly. That's exactly why ETFs are such a powerful tool for this conversation. They allow us to focus on patterns instead of predictions, behavior instead of headlines, positioning instead of timing. Now that we're clear on the tool, the next step is understanding the pattern. Because history gives us a surprisingly clear picture of how different assets behaved when markets actually broke, not in theory, but in real life. To see that, we need to zoom out and look at what happened during the last few major crashes, and more importantly, where money actually went when fear took over. Every major market crash has had a different trigger, different headlines, different villains, but when you look at the data, investor behavior under stress has been surprisingly consistent. Let's start with the dot-com crash in the early 2000s. Back then, the story was simple. The internet was the future and profits didn't matter. Companies with little revenue and no clear business model were being valued as if growth alone guaranteed success. When reality finally caught up, confidence collapsed. From its peak in March 2000 to its bottom in late 2002, the Nasdaq lost roughly 78% of its value. That wasn't a normal correction. Many tech stocks didn't just fail, they stayed down for years, and a large number of companies never recovered at all. But not everything collapsed equally. While speculative tech was being wiped out, defensive businesses held up far better. People didn't stop buying groceries, they didn't stop buying toothpaste, soap, or household essentials. At the same time, gold moved in the opposite direction from tech. Between 2000 and 2002, while the S&P 500 fell roughly 37%, gold gained value of around 20% as trust in equity markets weakened. On top of that, geopolitical shocks like 9/11 shifted capital toward defense-related industries as government spending increased and uncertainty around global security intensified. The lesson wasn't that one asset magically won, it was that when growth expectations break, investors rotate toward tangible value and necessity. Now fast forward to 2008, the financial crisis. This wasn't about tech hype, it was about leverage. Housing prices had been pushed far beyond reality, and the entire financial system was built on that assumption. When the housing market cracked, confidence in banks collapsed with it. Credit froze almost overnight, and markets fell hard and fast. In 2008 alone, the S&P 500 dropped about 38%, while many financial stocks lost 70% plus, and some failed entirely. Once again, capital didn't disappear, it moved. During that same year, gold finished up about 5% as investors questioned the stability of banks and currencies. Long-term U.S. Treasuries surged as interest rates were cut aggressively and money rushed toward assets backed by the government, with long-duration Treasury exposure rising more than 30% during the crisis. Investors weren't chasing growth anymore, they were chasing safety. Consumer staples also held up far better than discretionary spending. People cut back on travel, luxury goods, and big purchases, and they still bought food, soap, and basic household items. And while some technology companies struggled in the short term, many came out stronger on the other side, not because tech is always safe, but because balance sheets, cash flow, and profitability suddenly mattered more than stories. Now let's look at the most recent example, the 2020 pandemic crash. This one was different. It wasn't a slow buildup or a financial imbalance, it was a sudden global shock. Entire economies shut down almost overnight. Uncertainty exploded and markets reacted immediately. In just over a month, the S&P 500 fell roughly 34% as investors tried to make sense of something nobody had modeled for. Once again, the pattern repeated. Stocks fell fast, gold surged as fear peaked, finishing 2020 up around 25%. Long-term treasuries rallied sharply as interest rates collapsed, with treasury exposure gaining around 18% that year. Healthcare companies benefited as capital poured into vaccines, treatments, and medical infrastructure. And consumer staples remained resilient because even when the world paused, people still needed to buy basic necessities and live their daily lives. Now, here's the important part. If you step back and look across all three of these crashes, the triggers were completely different. The dot-com bubble was about speculation. The financial crisis was about leverage. The pandemic was about a global shutdown. But despite those differences, the underlying behavior stayed remarkably consistent. Risky growth assets suffered first, confidence broke, and money rotated into the same three places it always has: gold, assets that protect value when trust fades; U.S. Treasuries, assets backed by institutions investors still believe will pay; and defensive, essential businesses, the companies people can't stop spending money on even when times are tough. Now, in a couple of minutes, I'll show you an ETF for each type of asset people tend to hold when markets crash. And in the end, I'll show you how a simple portfolio made up of just these 3 ETFs could turn a $10 daily investment into a portfolio worth over $600,000, paying more than $22,000 a year in dividend income. The reason for using 3 ETFs isn't about finding the perfect investment for every crash. It's about understanding behavioral flows. When fear hits, investors don't suddenly become irrational, they become conservative. They prioritize survival over upside. They choose familiarity over excitement. And this is why trying to predict the next crash misses the point. We don't know what the next needle will be. It could be inflation. It could be debt. It could be something nobody's talking about yet. But we do know how people tend to react when uncertainty takes over. They look for protection, they look for safety, and they look for reliability. That's the pattern. And once you understand those patterns, you can start positioning around them instead of reacting emotionally when headlines get loud. That's exactly what we're about to do, because those 3 recurring behaviors map directly to 3 simple ETFs. And the first one represents the asset people have turned to for thousands of years when trust in the system starts to crack: gold. Gold has a strange reputation in investing. Some people swear by it, others dismiss it completely, and that split usually comes from a misunderstanding of what gold is actually supposed to do. Gold is not a growth engine. It doesn't innovate, it doesn't produce cash flow, it doesn't compound the way a business does. Gold plays a very specific role, and that role shows up most clearly when trust in the system starts to crack. Historically, gold has acted as a store of value during periods of uncertainty. When people become worried about currencies, banks, governments, or financial stability, gold often attracts attention, not because it's exciting, but because it's familiar. It's tangible. It doesn't depend on someone else's promise to perform. That's why gold keeps appearing during market stress. During the dot-com crash, when growth stories collapsed and confidence faded, gold gained. During the financial crisis, when banks were failing and trust in the system was shaken, gold rose as investors questioned paper assets. During the early phase of the pandemic, when uncertainty spiked and nobody knew what came next, gold moved higher as fear peaked. Different crises, same instinct. Now, this is where expectations matter. Gold doesn't always go up. There are long stretches where it does very little. When confidence is high, markets are calm, and growth is strong. Gold can lag badly. That's not a flaw, that's the trade-off. Gold tends to do its job when other things are struggling, not when everything is working perfectly. For most everyday investors, owning physical gold creates friction. Storage, security, liquidity, and transaction costs all become real considerations. That's why many people use a gold ETF instead. It removes most of the hassle while still giving exposure to gold's price movement. The ETF we're focusing on here is IAU. Its job is simple. It tracks the price of physical gold. It doesn't try to be clever, it doesn't use leverage, it doesn't trade actively. It's designed to mirror gold's movement as closely and efficiently as possible. One important detail that often gets overlooked is cost. Even small fees matter over long periods of time. IAU has a relatively low expense ratio compared to other gold ETFs, which means less drag on returns. It's also important to understand what you're not getting. IAU doesn't pay a dividend. There's no income. If you own it, your return comes entirely from price movement. That makes it very different from stocks or bonds. Again, that's not good or bad, it's just different. It exists to serve a specific purpose in a portfolio. Now let's talk honestly about gold's weaknesses, because skipping this part leads to unrealistic expectations. Gold can underperform for long periods. After strong runs, it can go sideways for years. When economic confidence improves, inflation fears ease, and growth assets perform well, gold often loses attention. That can feel frustrating if you're expecting constant movement. Gold can also be sensitive to sentiment. If fear subsides quickly, gold can give back gains just as fast as it made them. It's not uncommon to see gold spike during peak panic and then drift lower as conditions stabilize. That's why gold should never be viewed as a get-rich-quick asset. Its value isn't in explosive upside. Its value is in balance. It can reduce overall portfolio volatility and provide protection during periods when other assets are under pressure. It's also worth addressing inflation because gold often gets labeled as an inflation hedge. The reality is more nuanced. Gold doesn't respond to inflation numbers on a spreadsheet, it responds to expectations. When people believe inflation will erode purchasing power and policymakers are losing control, gold tends to attract interest. When inflation is high but confidence remains intact, gold can lag. This distinction matters because it explains why gold sometimes surprises people in both directions. Another factor is the dollar. Gold is priced globally, and changes in currency strength can influence gold's movement. When the dollar weakens or confidence in fiat currencies declines, gold often benefits. When the dollar strengthens and global confidence rises, gold can face headwinds. Again, this reinforces the idea that gold's role is contextual, not constant. Because of this, gold works best when it's sized appropriately. Too little and it doesn't move the needle during stress. Too much and it can drag on performance during long periods of calm. There's no perfect percentage that works for everyone. The right amount depends on how much volatility you can tolerate and how you react emotionally when markets move against you. The emotional component is critical. Gold can help investors stay disciplined during drawdowns. When stocks are falling and headlines are loud, seeing an asset that's holding steady or moving higher can reduce the urge to panic. That psychological benefit often matters more than the raw return itself. Gold also plays a role in rebalancing. When fear spikes and gold rises, trimming a portion and reallocating into beaten-down assets can enhance long-term returns. This isn't about trading, it's about using diversification to your advantage instead of fighting it. So when we talk about gold through the ETF IAU in this portfolio, we're not talking about a bet. We're talking about insurance. We're talking about resilience. We're talking about giving your overall strategy a way to respond differently when confidence breaks. Now, once fear hits the market, it doesn't stop at gold. Fear quickly turns into something more specific. It turns into a search for safety. Investors don't just want something that might hold value, they want something they believe will pay them back no matter how bad things get. That's where U.S. Treasuries come in. At their core, Treasuries are simple. When you buy one, you're lending money to the U.S. government. In exchange, the government agrees to pay you interest and return your principal at maturity. They're considered one of the safest financial instruments in the world because they're backed by the full faith and credit of the U.S. government. Now, here's where a lot of people get confused, so let's slow this down. Treasuries have two key parts, price and yield, and they move in opposite directions. Think of it like a seesaw. When prices go up, yields go down. When prices go down, yields go up. This relationship is critical to understanding why treasuries behave the way they do during recessions. When fear spikes and markets fall, investors rush into treasuries because they want safety. That surge in demand pushes treasury prices up, and when prices rise, yields fall. This is why you'll often hear about yields collapsing during recessions. It's a result of the massive demand for safety. At the same time, central banks usually respond to economic slowdowns by cutting interest rates. Lower rates make existing bonds with higher yields more valuable. That combination, falling rates and rising demand, can create powerful moves in Treasury prices during downturns. This is where TLT comes into the picture. TLT is an ETF that holds long-term U.S. Treasury bonds, generally with maturities of 20 years or more. The key word here is long-term. Longer duration bonds are more sensitive to changes in interest rates. That sensitivity cuts both ways. It increases risk, but it also increases potential movement. When rates fall, long-term bonds tend to rise much more than short-term bonds. That's why TLT has historically performed well during major recessions. In 2008, as the financial system cracked and rates were slashed, long-term treasuries surged. In 2020, when the pandemic hit and rates collapsed again, treasuries rallied sharply. Different crises, same flight to safety behavior. But just like gold, treasuries are not a magic asset. They have strengths and weaknesses, and ignoring the weaknesses leads to disappointment. The biggest risk with TLT is interest rates. When rates are rising, long-term bonds can struggle badly. Rising rates push bond prices down, and the longer the duration, the more pronounced that effect becomes. This is why TLT can be volatile outside of recessions. In periods of rising inflation or aggressive rate hikes, it can lose value even while paying interest. This is also why it's important to understand what TLT is not. It's not a growth asset. It's not designed to outperform stocks over long bull markets. Its role is to respond aggressively when rates fall and fear peaks. In calm, rising rate environments, it can feel frustrating or even painful to hold. But that frustration is part of the trade-off. TLT tends to do its best work when stocks are doing their worst. That negative correlation is incredibly valuable during true market stress. When equities are falling and volatility is high, seeing treasuries rise can stabilize a portfolio both financially and emotionally. TLT also provides income. Based on your metrics, it currently offers a yield of about 4.01% with long-term income growth around 10.34% through reinvestment and changing rate environments. While prices fluctuate, that income helps smooth returns and provides cash flow during uncertain periods. Now let's address a concern that comes up a lot today: government debt. Many people worry about how much debt the U.S. government has and whether that undermines treasuries as a safe asset. It's a fair question. But historically, during crises, investors don't ask whether the system is perfect. They ask which part of the system is most likely to pay them back. And time again, treasuries have remained a primary destination for global capital during stress. Even investors who criticize government policy often still use treasuries as a hedge. Another important nuance is inflation. High inflation can hurt bonds, especially if rates are rising to fight it. But recessions often bring disinflation or deflation pressures. Demand falls, growth slows, central banks pivot. In those environments, treasuries can regain their defensive role quickly. This is why TLT works best as part of a broader structure, not a standalone bet. It complements gold by responding to a slightly different fear. Gold responds to trust being broken. Treasuries respond to panic and policy shifts. But there's still one more piece missing. However, before that, it's essential to address something that's often overlooked in many investing conversations. Not all downturns look the same. And more importantly, not all downturns feel the same while you're living through them. Most people imagine a clean crash. Stocks fall fast, panic hits, rates get cut, then things recover. Look, reality is rarely that simple. There are two broad types of downturns, and neither one feels good while you're living through it. The first is a deflationary panic. Demand collapses, spending slows, businesses struggle, unemployment rises, markets fall quickly, and fear takes over. In these environments, investors rush towards safety. Interest rates usually come down, liquidity matters more than growth. This is when assets like Treasuries tend to perform well, because falling rates push bond prices higher and investors want something they believe will hold up as risk assets break down. Gold can also play a role early on when uncertainty is highest and trust starts to crack. The second scenario is more frustrating, an inflationary squeeze. Growth slows, but prices stay high. Costs rise, purchasing power gets squeezed, confidence erodes slowly instead of collapsing all at once. Interest rates may stay elevated longer than expected, which pressures bonds and makes growth investing harder. Nothing feels cheap, nothing feels safe, and patience gets tested. Here's the key point: nobody knows which of these comes next. Sometimes elements of both show up at the same time. That uncertainty is exactly why building a portfolio around a single outcome is so risky. This is where defensive businesses start to matter. Unlike gold or treasuries, they don't rely on fear or rate cuts to function. People still buy food. They still pay for essentials. And income from those businesses can make it psychologically easier to stay invested when everything else feels uncertain. That's the missing piece we need to talk about next. And filling that gap is SCHD. Now, once we've covered it, we'll have a complete portfolio. Then I'll show you the exact percentage allocation for each ETF and how this 3 ETF portfolio could turn a simple $10 daily investment into a $600,000 plus portfolio that pays over $22,000 in annual dividend income. But before we put everything together, let's take a closer look at the final piece of this 3 ETF portfolio, SCHD. This is an ETF built around high-quality U.S. companies that pay dividends, but it's not just chasing the highest yield it can find. It focuses on businesses with strong cash flow, solid balance sheets, and a history of returning money to shareholders. In other words, companies that can keep paying you even when growth slows. This distinction matters. Chasing yield alone leads investors into fragile companies that cut dividends the moment conditions tighten. SCHD avoids that trap by emphasizing dividend sustainability and financial strength, not just headline numbers. From a numbers standpoint, SCHD is designed to do 3 things well all at the same time. It currently offers a dividend yield of about 3.81%, meaning investors are paid real income while they hold it. That income hasn't been static either. Historically, over the last decade, SCHD's dividend has grown at an average rate of about 10.61% per year, which is a critical detail. Growing income helps offset rising costs and protects purchasing power over time. On top of that, SCHD has delivered an average share price appreciation of roughly 8.06%, showing that it hasn't sacrificed long-term growth to generate income. SCHD is not designed to explode upward in bull markets. It's not a high-growth ETF, and that's intentional. Its job isn't to win every year. Its job is to be reliable across many years, especially the difficult ones. During strong bull markets, it may lag more aggressive strategies. During downturns, it often falls less and recovers more steadily. This trade-off is exactly why it works so well alongside gold and treasuries. Gold handles fear-driven spikes. Treasuries handle panic-driven safety moves. SCHD handles the long, uncomfortable middle. It keeps working when markets are choppy, unclear, or frustrating. There's also a compounding effect that's easy to underestimate. Dividends don't just provide income. When reinvested, they buy more shares. Those shares generate more dividends. Over time, this creates a snowball effect that accelerates growth, especially during periods when prices are lower. This is one of the reasons defensive dividend strategies often surprise people over long time horizons. They don't look exciting in any single year, but they build momentum through consistency. Another benefit of SCHD is diversification. Instead of relying on a single industry or company, It spreads exposure across many high-quality businesses. That diversification reduces the risk that one company's problems will derail the entire strategy. So now we've covered the three building blocks: gold for when trust cracks, treasuries for when panic hits, defensive income for when patience gets tested. Each ETF plays a different role. On its own, none of them is complicated. The real question is what happens when you put them together and let time do the work. Up to this point, we've talked about behavior, history, and positioning. That explains why these assets exist in the portfolio, but it doesn't answer the question most people actually care about. What does this turn into over time? To answer that, we need to be specific about the structure. This portfolio is split intentionally across three roles. 25% is allocated to gold through IAU, which carries no dividend and no dividend growth, but historically has delivered average annual price appreciation of about 14.79%, acting purely as a value protection asset. 25% is allocated to long-term U.S. Treasuries through TLT, which currently pays a dividend yield of about 4.01%, has shown average dividend growth of around 10.34%, but has experienced negative average price appreciation of roughly negative 3.33%, reflecting its sensitivity to current interest rate cycles. The remaining 50% is allocated to SCHD, the defensive income engine of the portfolio. With a current dividend yield near 3.81%, dividend growth around 10.61%, and average share price appreciation of about 8.06%. When you combine those weights, the portfolio as a whole produces a blended dividend yield of roughly 2.91%, with average dividend growth close to 7.89% and long-term average price appreciation of about 6.9%. That tells us how the portfolio is structured. Now let's look at what happens when you actually use it. Instead of a lump sum or perfect timing, assume a simple habit, investing $10 per day. That adds up to $3,650 per year. So after 1 year of investing, your portfolio value will be about $3,650. After 10 years, the portfolio is projected to grow to roughly $58,131. After 20 years, the curve steepens. The portfolio reaches approximately $213,318. This is where compounding becomes visible. Market growth begins to rival the money you personally put in, and after 30 years, the portfolio grows to about $644,388. But the balance alone doesn't tell the full story. By year 30, the portfolio is projected to generate about $22,405 per year in dividends, which works out to roughly $1,867 per month. Now look where the total value came from. Over 30 years, the total value added beyond contributions is about $534,888. Of that, roughly $350,323 came from capital appreciation. The remaining $184,565 came from dividend reinvestment. Want to know how a simple $5 a day investment can grow into a portfolio that pays more than $8,000 a month in dividend income? Click the video on the screen to find out.